Well, thank you very much for that warm introduction, Tiff. And it's just great to be here. I've been in this room before, and I've had the pleasure of receiving the hardest questions from the students, and so I'm looking forward to that at the end. I mean, here we are. It's 10 years after the crisis, and we're here in this room, still tallying its costs. We're trying to understand its causes, and we're trying to learn some lessons from it. And, you know, it would have been even worse in 2008 and afterwards if it hadn't been for the concerted efforts of policymakers in Canada and around the world to take actions to boost demand, but also to repair the financial system. And I can say that despite those efforts, it's been estimated that the crisis cost the world economy about 62 million jobs and over $10 trillion in lost output. Well, that's a lot. I mean, Canada's recession was less deep than experienced in the countries that were at the epicenter of the crisis, but it was still painful for many people. And it took more than a decade and a series of aftershocks to get to a place where we feel that emergency measures like ultra-low interest rates may at last no longer be needed. Now, there's still uncertainty about trade policies that continue to cloud the outlook in Canada and elsewhere, but for a central banker like me, it really feels like this moment has been a long time coming. Now, we responded to contagion at the time of the crisis from abroad with aggressive monetary policy actions, and if you do some estimates, you can find that without the actions that the Bank of Canada took, the recession in Canada might have lasted a year longer and cost another 500,000 jobs. And we worked with our Canadian and our international colleagues, and some of you here in the room, it's really nice to see you, to put critical programs in place to ensure liquidity in core funding markets and the interbank funding markets that we heard about this morning. And this was new for central banks. And we cooperated on a series of global financial reforms. I was personally involved in a number of them, and so I know just how much a collective effort this was. I mean, many of you here today have worked hard in your own institutions to comply with new rules and shore up risk management. So we've accomplished a lot. But let's face it, the job's not done. I would probably argue the job's never done. Whenever you have a chance to cite or quote Winston Churchill, you probably should, so I will, because there's something he said that really fits. He says, "All men make mistakes, but only wise men learn from their mistakes." And so I think it is wise to have conferences like these so we can continue to reflect on what went wrong. And that's why I'm very pleased to be here to speak, and I'd like to thank the organizers for the invitation. Now, the experts who spoke before me gave us insights into the genesis of the crisis, the subsequent lessons. We just heard about what might be on the horizon. And my intention here is to push the conversation forward and spark discussion in three areas where I believe we have some unfinished business. And the first is understanding the role of monetary policy in financial stability. If there's one lesson that we've learned since the turn of the century, it's that price stability does not guarantee financial stability. And the second is that keeping policy current as risks to the system evolve is just fundamental. Leverage and liquidity are important. They're the usual suspects. They probably still will be. But the trickiest part may be in understanding the risks that stem from interconnectedness in an ecosystem that's changing very rapidly. And the final area is being ready for when things go wrong. Being well prepared is not just a Boy Scout thing. It's what helps keep financial damage to a minimum, and especially for those who didn't take the risk in the first place. Now, central banks, along with other authorities, both domestically and internationally, have a strong role to play in all these areas. So I'm going to start with the role of monetary policy in financial stability. You probably learned in your Economics 101 class that monetary stability, as low, stable, and predictable inflation, is really at the heart of a solid macroeconomy and also of financial stability. And since the Bank of Canada adopted its inflation target in 1991, there has been a reduction in the variability of economic growth by more than 1/3 and in employment by 40%. And those numbers even take into account the crisis period. This has been beneficial to everyone, but particularly so for younger people and workers who have a lower level of education. That's because they tend to have more precarious employment situations. Now, successful inflation targeting in Canada and elsewhere is considered to be one of the factors behind this great moderation that we heard about earlier. And that's together with some helpful changes to structural policies, as well as, to be frank, a little bit of good luck. Now, we know that many factors contributed to the crisis, including inadequate regulatory safeguards, as well as global macroeconomic imbalances. But that said, the crisis made it really clear what some economists had suspected prior to the crisis, and that's that price stability alone doesn't guarantee financial stability. And it could, in fact, in some circumstances, contribute to the buildup of financial vulnerabilities. Now, central bankers were, of course, already aware that vulnerabilities could build up via the traditional transmission channel that works through asset prices and credit markets. But we learned the hard way that another channel, they call it the risk-taking channel, could be a powerful amplification mechanism. And it's now evident that low interest rates encourage people not only to borrow more, but to make riskier investment decisions. That's because they want higher returns. Now, of course, hindsight's 2020, but we can all think of an episode that fits this risk-taking narrative. And for me, it's a substantial rise in the issuance of structured credit in the mid-2000s. I mean, that facilitated a huge increase in subprime mortgages and leveraged buyouts that were driven by private equity. Now, the unfinished business here is to come to a consensus about what monetary policy can and what monetary policy should do about financial vulnerabilities. And this is especially in a world where the neutral rate of interest is pretty low. We also want to know how monetary policy fits into the rest of the policy framework. Now, clearly, micro and macroprudential regulation are on the front line of all this. Inflation targeting is the central bank's primary mandate. Nevertheless, we do take financial stability considerations into account in our monetary policy decisions, and that's consistent with our risk management approach. Let's just take the current situation that we're in right now as an example. We've got high levels of household debt, and the Canadian economy is operating close to potential. And that means that monetary policy actions to achieve the inflation target and support financial stability are complementary. Now, we've underscored the fact that there's nonetheless a fine balance to strike here. While moving too slowly could allow more time for financial vulnerabilities to build, moving too quickly could have outsized effects, especially given the high level of household indebtedness. Now, there may be completely different situations, a case for taking longer to bring inflation back to target than the usual 6 to 8 quarter horizon. And this was a case that we actually considered in 2013. You probably remember that inflation at that time was running below target, and the economy had excess capacity, which might have warranted an easing in policy. However, we judged that the best course of action at that time was to leave our policy rate at 1% in order to avoid exacerbating financial vulnerabilities in the household sector, while at the same time achieving our 2% inflation target over a reasonable time horizon. Now, there's still a debate about how to integrate financial stability considerations into monetary policy. It's not perfect. And I'd like to highlight a couple of promising avenues that could help advance the discussion. And the first is to invest in policy models that do a much better job of capturing the interlinkages between the financial system and the real economy, such as those that can lead to defaults in loans or asset fire sales or other things that we actually observe in the real world. I don't believe that any model is ever going to be perfect. And so we do need to get used to operating in a world with a heavy dose of uncertainty. Yet, I believe this research has promised to shed more light on how monetary policy should respond to a buildup of financial vulnerabilities, if at all. The second area that I think we should advance on is strengthening our framework for macroprudential policies, which are better suited to target financial system risks. If we take a page from the inflation targeting regime, we can see that there is a real benefit to having clarity about the objectives, the governance, and the tools for the job. The focus in Canada has most recently been, quite understandably, on macroprudential policies that are related to household finance and to improve the quality of debt and to limit its growth. And many of these policies, such as the recent changes to mortgage underwriting rules that we fondly called B20, are aimed at increasing the resilience of the financial system on an ongoing basis. But authorities could also use other tools to dampen financial cycles and to boost the resilience of the banking system when bank credit has been growing rapidly. Now, an example of this kind of tool would be the countercyclical capital buffer that was introduced as part of the Basel III reforms. The Bank of England has put such countercyclical measures in place, and the Office of the Superintendent for Financial Institutions is working now on implementing a similar measure in Canada. Now, despite the promise of macroprudential policies, we really need to be humble about what we know about them in practice. And that's because in Canada and around the globe, we actually have very little practice, especially if you compare that with our experience with inflation targeting, which spans in some countries over 25 years, just over 25 years. And so as we gain experience with these tools in Canada and abroad, we need to work to sharpen our understanding of their effectiveness. And we should develop a well-functioning framework in which monetary policy and macroprudential policies reinforce each other. I think the risk is that without a solid framework, there will be undue pressure for monetary policy to lean against the buildup of financial vulnerabilities. And this could lead to really suboptimal outcomes for both monetary policy and financial stability, given the bluntness of the interest rate tool. That's why it's imperative that academics and central banks focus our efforts in a number of areas. At the Bank of Canada, we've been exploring new sources of microdata to assess the vulnerabilities. All the vulnerabilities are actually in the distribution. They're not in the averages. We want to monitor the impact of macroprudential actions. And whether it's traditional data or big data, the usefulness of these data really come down to what you do with them. And so we're developing our policy models here too to have relevant institutional features that take into account differences in income and wealth so that we can get a better handle of the effectiveness of macroprudential tools for different groups of people and for the economy as a whole. So even with improvements in these areas, we know that monetary policy and macroprudential policies are going to be insufficient to fully safeguard financial stability. And this brings me to my second area of unfinished business, which is that our regulatory and supervisory practices need to stay current as risks evolve. We just heard in the last panel that some people think that public policymakers are a little bit slow. Well, I think that the key issues that got us into the crisis, leverage, illiquidity, and interconnectedness, are still the right ones to look at. And we have taken great steps to identify and to mitigate these vulnerabilities in financial institutions. We've got Basel III that's largely in place. We've enhanced bank resolution tools and shifted the largest portions of over-the-counter derivatives to central counterparties. And many of the weaknesses in market-based financing that used to exist made the system vulnerable before the crisis have been addressed. But the job is never done. I said that at the beginning, and I'm going to say it a couple of times, because risk is constantly shifting. And it's shifting both inside and outside the regulated financial sector. And we learned from the crisis that while trouble is always a complex brew, financial innovation is usually a key ingredient. Now, financial innovation hasn't slowed since the crisis. I don't need to tell you that. And we all agree that it can often help improve the financial system. That's not disputable. But we know that it can also carry risks. And that's why risk management needs to become more nimble. And there's a couple of areas that worry me right now, and I think they need concerted attention. And both relate to interconnectedness and to trust in the system. My first concern is one that I know is shared by many here in relation to your own activities, and that's cyber risk. In fact, I read the recent survey conducted by RiskNet that found that IT disruption leads the top 10 operational risks for 2018. It's not really surprising, and because when it comes to cyber risk, we really are all connected. Now, some new technologies, like cloud computing, may be safer than legacy systems, and we shouldn't lose sight of that. Yet cyber risk is heightened in other ways with the new digital economy because of an increasing number of points of access to core parts of the financial system and the growing sophistication of those launching cyber attacks. It's just part of our digital world. Now, the Bank of Canada is responsible for the oversight of financial market infrastructure. We already impose very strong requirements to support the stability of these infrastructures, like payment systems and central clearing counterparties. And we're working to further contain and respond to cyber risks. Now, the systems that underpin all financial transactions in our economy are highly interconnected. So a cyber attack on one could quickly spread and cause major disruptions. And the costs may not stop there. Households and businesses typically don't think about these systems because they operate smoothly behind the scenes. When's the last time one of you thought about the large value transfer system? Well, probably never. And I actually take that as a compliment, being the overseer. But trust in core systems could be undermined if participants felt that their information or assets were vulnerable. And that's why we're working with Payments Canada and the 6 largest Canadian banks to reduce the chance of a serious cyber event and to mitigate the impact and recover quickly if such an event were to materialize. Now, my second area of concern is related to the rapid pace of financial innovation. Of course, innovation can bring lower costs and increase the range of investment strategies. Exchange-traded products, for instance, offer investors relatively easy access to liquid and complex strategies. And some of these strategies rely on derivative structures that have counterparty and collateral risks. These products can be surprisingly troublesome if they're not well understood, yet they become popular, especially with retail investors. This kind of harkens back to Canada's experience with third-party asset-backed commercial paper heading into the crisis. There's a recent, although much more contained example with respect to inverse volatility exchange-traded products. I mean, many investors were attracted to the high returns that could be earned on these products in the low volatility environment that we've seen in recent years. But of course, if you know anything about these products, you know that you can liken them, and they have been likened to picking up nickels in front of a steamroller. And at the beginning of February, these products lost nearly all of their value in one day as U.S. equity volatility spiked. Now, the good news, and it really is good news, and that's that markets were resilient to this event. The unease is still there because, aside from the obvious suitability issues, many were unaware of the extent to which these products had underlying linkages. And here I'm talking about the interlinkages between leveraged long and short volatility products. These interlinkages, or you can call them dynamics, work to amplify the volatility by creating a one-way trade in VIX futures. So even further along the risk spectrum are the private crypto assets. And you might notice that I'm not referring to them as currency because the existing products actually do not perform any of the functions of money. And while the activity may be too small right now to be systemic, at some point they could have implications for financial stability. The crypto world is moving really fast, and it's largely unchecked. And it certainly, at a minimum, raises concerns about investor protection, about market integrity, and its use in illegal activities. And just to be clear, the issues here I'm talking about are related to the products. It's not related to the underlying technology. As many of you know, Bank of Canada is doing experiments using DLT technology. But we know that there is evidence of widespread use of some crypto assets for money laundering and other illegal activities, and some rather spectacular incidents of theft and fraud have occurred. And we've seen significant financial risk, given the volatility and the illiquidity of the assets. Authorities should work towards a coherent, and I mean internationally coherent, set of policies for crypto assets that are aligned. And this strategy will need to cover both the risks in the cash and the derivatives products, as well as the related ecosystem. The Canadian Securities Administrators launched work on cryptocurrency offerings last year, noting that where appropriate, they're treating these assets as securities. I just returned from Buenos Aires, where the G20 was meeting, and I was really pleased that the G20 countries are increasing their focus in this area, given the global nature of the products. So my bottom line here is really that we need, in an environment that's changing rapidly, a sharpened focus on consumer and investor protection and market integrity, and one that starts earlier on in the process. And this is because market integrity and trust are just foundational elements to a stable financial system. Now, the last area I would like to highlight is readiness. We need to be prepared for when things go wrong. It's just impossible to get rid of all the risks, and it's pretty undesirable too. A modern economy advances because people work hard and because they're willing to stick their necks out. And what that means is that some risks are going to materialize. That should be okay. A system should be able to withstand some failures, but they should be able to withstand them without imposing huge costs on those who did not take the risk in the first place. And we've made a lot of progress in a number of areas, but more still needs to be done. Central banks and international policy organizations have worked to develop early warning indicators for risks to the global financial system. And I think these are helpful as a starting point, but we really need to recognize the limitation of these early warning indicators, particularly if they rely on deviations from historical trends or threshold values. And that's why it's important to push the analysis further to properly gauge the risk. I think stress tests are an excellent way to help us understand what could happen if financial institutions were subjected to adverse events, like a steep house price decline or a Brexit vote. What they do is they provide practical information about what might be needed to withstand and recover from these events. Now, the Bank of Canada works with other organizations like OSFI and the IMF to conduct regular stress testing exercises of financial institutions. And the unfinished business here is really that the models used for stress testing capture mainly first-round effects. And that means there's a very limited ability to identify spillovers that we know can end up being even more important. For example, the bank's current framework does capture some second-round effects that come from interbank exposures and from asset fire sales. There's a lot of room for improvement because we could introduce behavioral aspects, like the reactions of bank managers and other financial market participants, as well as the feedback to the real economy. And what this would require is a mapping of a broader range of interconnections among financial players. It's not a trivial exercise. We would also need to keep this mapping fresh by considering changes in the financial system that might affect the results. And here an example is the potential changes in the stickiness of retail deposits in a world where you have open banking. Of course, it's not all about banks. Stress testing frameworks have been designed for central clearing counterparties to test their resilience to the failure of one or more participants. Many of you know that central clearing counterparties have similar participants across the world, and there's a scope for contagion effects. So more work is being done here as well. We know that being well prepared does increase the odds that a financial institution will recover from a stress event, but we also know that recovery is not always possible. effective resolution regimes and credible plans are needed to resolve systemically important financial institutions. Together with other members of the FSB, Canada is committed to establishing effective resolution regimes for our banks and for our FMIs. As part of this effort, Canada introduced a legislative framework for a bail-in regime. And that's to ensure that people who invest in long-term bank-issued debt, along with equity holders, share in the financial burden of resolving systemically important banks. Now, aside from protecting the taxpayer, this kind of regime will help avoid adverse implications for the distribution of wealth that can follow a bailout. It will also support market discipline on banks in good times. Now, development of the rest of the framework is also underway. We've got Canadian banks who are working hard with CDIC on their resolution plans. And these plans are particularly complicated when you have a financial institution with significant cross-border activities, because you need to coordinate with the host authorities as well. With respect to Canada's systemically important financial market infrastructure, this year's federal budget included plans to implement a resolution framework, and there's more work that needs to be done here. But rest assured, we won't be satisfied until all these plans meet an appropriate standard. So it's time to wrap up. Janet Yellen said in 2009 that an imperative for sustained economic recovery following a financial crisis is a thoroughgoing repair of the financial system. And on this front, we've accomplished much over the past decade, and we're now reaping the benefits. They may not be durable unless we focus on some unfinished business, refining our understanding of the role of monetary policy in supporting financial stability, keeping regulatory and supervisory policies current as risks evolve, and planning for recovery and resolution when things go wrong. The Bank of Canada is committed to playing a strong role in all these areas, both domestically and at international tables. And let's just all remember that whether it's through our own financial decisions, our advice to policymakers, or our policy actions, we all play a role in the health of the financial system and the trust that people put in it. Thank you.
Well, thank you, Carolyn. I'm feeling reassured after a few of those most scary presentations that the bank is on top of this. But Carolyn has generously agreed to take a few questions. So if you have a question, put your hand up. You know the system now. Somebody's going to bring you a mic, and Carolyn will give you an answer. Over here.
Thank you, Deputy Governor. My name is Louis Gagnon from the Smith School of Business. So you've talked about unfinished business. You've laid out a number of unfinished business items. What I'd like to know is, of all these, or perhaps others, what keeps you up at night?
Well, I sleep very well in general. I have to say that there's two risks currently that keep me up at night. One is related to the household sector in Canada and the high indebtedness. Clearly, we've put in place some very nice macroprudential measures that are appearing to have the desired effects in terms of quality of debt. We've seen that in the data, and we're hoping to see more of it as the year progresses with the most recent changes that are with respect to uninsured mortgages. At the same time, we've increased interest rates by 75 basis points, and we're looking to see what the effect of that will be on households. And so things seem to be going in the right direction, combined with the fact that the global economy seems to be in a very synchronized expansion. But at the same time, that vulnerability is still there and would be a factor if the Canadian economy were to be hit with an adverse shock. I think that would be number one. Number two is the cyber risk, and I talked about that today. I think there's a lot of scope that can be done both domestically and internationally to not only improve our ability to avoid a cyber attack, but really be cognizant of the fact that a serious one could occur. And so a lot of effort needs to be put into how do you respond to that and recover. Some good work going on, but more needs to be done.
Hi, I'm Andreas Park from Rotman here. So I have a question about the regulation of crypto assets that you alluded to earlier on.
Yeah.
And I have a bit of a problem with that for the following reason. If you go back in time, famously, it was either in 2012 or 13, the existing crypto world had their bank accounts cancelled in Canada. Now, that was not the Bank of Canada's fault, but it made it basically impossible for instance, the Ethereum Foundation to raise money to pre-sale their token here in Canada. So what happened? Well, they moved to Switzerland. Now, was that a good move to have them move away from Canada to Switzerland? I think for Canada, it's terrible. Now, the question I have here is, it's a little bit of a broader question, but why do we actually need to classify these assets, these items, as a security? Why can an ICO or token not be a token? Why can we not think about a creative way to think of a regulation and think of essentially something that's a pre-sale and it's just a digital item for it? So the Swiss, for instance, have a regulation in place where they're trying to do precisely that kind of formulation and where they're trying to simplify the regulation. And the concern that I have is that we're using a regulatory baseball bat and just stifle innovation entirely.
Mm-hmm. So what is true is that not all crypto assets are the same. There's a lot of heterogeneity, and so one might be a commodity, one might be a security, one might be a token, and the work that we're doing domestically and internationally recognize that. The question is, in my mind, is just putting it on a level playing field with other forms of raising money and making sure that the business model that's being encouraged by a lack of regulation is based on sound foundation and not on regulatory arbitrage. Okay, an advantage that's coming from skirting around regulations that otherwise should apply. And that's particularly important because what I said in my speech, you need market integrity, you need trust in the system for it to work. Whether you have a centralized system or a decentralized system, there's no difference. This idea that somehow the new technology is going to turn us into a society and have an ecosystem in the financial sector that doesn't rely on trust, at least between individuals, I think is just not right. And so it's very important that we define what these things are. They are built before the toothpaste gets out of the tube, as Tiff put it earlier, and that even more importantly, that it's as consistent as possible across countries, because obviously these are often services that are ubiquitous and cross-border, and so the scope for regulatory arbitrage is quite high.
Other questions?
Hello, Nicholas Wan, S&P Ratings. Thank you for coming to speak to us and taking our questions. You mentioned the work that's been done towards orderly resolution of systemically important banks. Mm-hmm. If you'll forgive me asking a somewhat provocative question, given in Canada we have the happy experience of not having very many failures of large banks, but that also means these systems don't get a lot of practice. So why should we believe that they work, particularly in the case of a major problem with more than one bank at the same time?
So, well, clearly you never know if a plan's going to work until you test it in real time. So that's always going to be the case. And the situation for a domestically, systemically important institution, and in one case a globally systemically important institution, it's even more complex to think that through, because the activities of the institution are that much more complex. Its corporate structure is is complex, and there are cross-border implications. So I agree that it's a tough job. I think what people can expect is a plan that is better than no plan at all, first of all. So, and one that will be thoroughly tested in simulation exercises, not only in Canada, but eventually cross-border. So there'll be some fire drills, and I believe that really the only way to reduce the risk of a very disorderly and disruptive failure of an institution is to have a really solid plan, and that's what we're working on. Now, is there a plan that will never, in any scenario, not involve the government in some way? I doubt it. I mean, even right from the get-go, you've got CDIC involved. What we're trying to achieve is, as much as possible, those who were creditors to the bank, who invested in the bank, are the ones, at least on the front lines, who help pay for the resolution of that institution.
Could you reveal when the Bank of Canada is going to launch a national cryptocurrency?
That's a great question. The answer is no, but that's because there's been no decision to issue a national central bank digital currency. That being said, we have a research program that is looking at digital currencies, central bank digital currencies, both on the wholesale side and on the retail side. This is experimental research work that's real research in the sense of academics studying the economics of it, but also research in terms of, practically speaking, having our IT people and others work with the technology itself to test different platforms. The reason we find that so important is a couple of reasons. One is whether we do it or someone else does it, at some point digital is going to catch on, and the only way to understand it, in my view, is to get in early on the ground level and work with the technology and the entrepreneurs, the people in the industry who are also working on it. I think the second reason is that in the case of wholesale, there is an opportunity to learn more about how payment systems can actually be made more efficient. If you think about why I'm thinking cross-border payments, I'm thinking security settlement, these kinds of processes where you've got a lot of people in the middle, and you mentioned that. And the reason I think it behooves us to do that is that one of the reasons these things are popping up is because they can make things more efficient. They can reduce costs. And so if you want to work in favor of innovation, the place to start is your own business. And so on the wholesale side, I think there's some opportunity on the security settlement. There's some opportunities in cross-border payment. They're experiments, but they're ones that we're pursuing. On the central bank digital currency retail side, it's a different story. There's a lot more implications for the banking system and for people more generally if we were to embark on that. Our interest in looking at that is twofold. One is that this is happening right now. Bitcoin doesn't look like it's going to be the next new thing that will actually turn into a currency. That doesn't mean that at one point there won't be one. And in a case of a cryptocurrency or a currency that's not denominated in a national currency, that raises significant issues for domestic implementation of monetary policy, not only in Canada, but in any country that's affected. It affects your ability to carry out lender of last resort, which is just so critical. A market maker of last resort, just so critical when there's a crisis. And so you don't really want to get behind the curve and having thought about how you might do it if you decided it was a good idea. I think the other one that people don't talk about a lot is related to that banknote that you may or may not have in your wallet is actually your access as an individual to final settlement in central bank money. It's a riskless asset, and it's available to every Canadian. Every citizen has access to that. If you no longer have cash, and all digital forms of money, whether they're denominated in sovereign currency or not, it would be delivered in a way that would involve credit risk, going through a financial institution or another institution. And you have to think hard about whether that matters. Is money a public good or not? And so that may seem awfully theoretical, but it would seem awfully real if you no longer had access to cash. And so those are a couple of motivations. It really is research. There are lots of things to think through, including some that the Financial Stability Board have talked about, which I fully agree with and have contributed to, which is how it's constructed, how it's distributed would have potentially profound implications for existing financial institutions, and certainly no central bank would implement such a scheme without having thought those through very carefully. Yeah.
I think we better let you off the hook now.
Okay.
Please join me. Very good. Carolyn, I want to thank you. I think our strategy of saving you to the end worked marvelously. You have pulled together a number of the themes of the conference and really given us very, very comprehensive answers. So on behalf of everybody, thank you.